Welcome back to the Investing Iguana, the show where we explore the wild and wonderful world of crypto and finance. I'm a co-host, Larry, and today we're going to talk about a hot topic that has been making waves in the crypto space: stablecoins. Stablecoins are a type of cryptocurrency that are designed to have a stable value, usually by being pegged to a fiat currency, like the US dollar or a commodity like gold. They are supposed to offer the benefits of crypto, such as fast transactions, low fees, and global accessibility, without the drawbacks of volatility, price fluctuations, and market risks. Sounds pretty cool, right? But there's a catch. Stablecoins are not very well regulated around the world. Many countries are still figuring out how to deal with them, and some are even banning them altogether. This creates a lot of uncertainty and confusion for investors, users, and issuers of stablecoins. But there's one country that seems to be ahead of the curve when it comes to stablecoin regulation: Singapore. The city-state has recently announced that it has finalized its regulatory framework for stablecoins, making it one of the first jurisdictions in the world to do so. So what does this mean for investors? How does Singapore's approach differ from other countries? And what are the implications for the future of stablecoins and crypto in general? That's what we're going to find out in this video. But before we dive in, make sure you hit that like button. Subscribe to our channel and turn on the notification bell so you don't miss any of our awesome content. And if you have any questions or comments, feel free to leave them below. We love hearing from you. All right, let's get started. Singapore's Stablecoin Regulatory Framework. Singapore's Stablecoin Regulatory Framework is based on two key principles: reserves that back stablecoins must be held in low risk and highly liquid assets. They must equal or exceed the value of the stablecoin in circulation at all times. Stablecoin issuers must return the par value of the digital currency to holders within 5 business days of a redemption request. These rules aim to ensure that stablecoins are backed by sufficient and reliable assets, and that users can easily redeem their coins for fiat currency if they want to. They also require issuers to provide appropriate disclosures to users, including the audit results of reserves. These rules apply to stablecoins that are issued in Singapore and mimic the value of the Singapore dollar or any G10 currency, such as the US dollar or the euro. Stablecoins that meet these requirements will be recognized by the regulator as mass-regulated stablecoins, which will distinguish them from tokens that are not regulated. Singapore's approach is different from other countries in several ways. It focuses on the economic function and risk profile of stablecoins, rather than their legal form or technology. This means that it does not matter whether a stablecoin is issued on a blockchain or not, as long as it meets the regulatory standards. It adopts a proportional and risk-based approach rather than a one-size-fits-all approach. This means that different types of stablecoins may be subject to different levels of regulation, depending on their size, scope, and impact on the financial system. It supports innovation and competition in the crypto space, rather than stifling or restricting it. This means that it allows new entrants and existing players to offer stablecoin services in Singapore as long as they comply with the rules and protect consumers' interests. Singapore's regulatory framework is not perfect, however. It still has some limitations and challenges. It does not cover all types of stablecoins, such as those that are backed by other cryptocurrencies or algorithms. These may pose different risks and require different regulations. It does not address some of the broader issues related to stablecoins, such as cross-border coordination, anti-money laundering, consumer protection, taxation, and legal tender status. These may require further consultation and cooperation with other regulators and stakeholders. It does not guarantee that mass-regulated stablecoins will be accepted or recognized by other jurisdictions or platforms. This may affect their interoperability and liquidity in the global market. The future of stablecoins and crypto regulation. Singapore's regulatory framework for stablecoins is a significant step forward for the crypto industry. It shows that regulators can adopt a balanced and pragmatic approach that supports innovation while mitigating risks. It also sets an example for other countries that are looking to regulate stablecoins in their own markets. However, Singapore's framework is not the final word on stablecoin regulation. It is likely that other countries will have different views and approaches on how to deal with this emerging phenomenon. Some may be more restrictive or hostile towards stablecoins, while others may be more supportive or friendly. This means that investors need to be aware of the different regulatory environments and risks that may affect their stablecoin investments. They also need to do their own research and due diligence before investing in any stablecoin project or platform. They should not rely on the label or reputation of a stablecoin alone, but rather look at the underlying assets, governance, and transparency of the issuer. Stablecoins are not a panacea for the crypto industry. They are not without flaws or challenges, but they are also not a threat or a fad. They are a promising and innovative solution that can offer many benefits to users and investors. They are here to stay, and they will likely play a key role in the future of crypto and finance. Singapore's new stablecoin rules are likely to have a significant impact on investors in the country. Here are some of the key ways in which the rules will affect investors. Increased transparency and accountability. The rules require stablecoin issuers to be licensed by the Monetary Authority of Singapore MAS and to maintain a minimum level of reserves. This will increase transparency and accountability in the stablecoin market, making it easier for investors to assess the risks and merits of different stablecoins. Reduced risk of fraud and abuse. The rules also require stablecoin issuers to implement robust risk management controls. This will help to reduce the risk of fraud and abuse in the stablecoin market, which could protect investors from losses. Improved investor protection. The rules also provide for a number of investor protection measures, such as requiring stablecoin issuers to offer timely redemption at par value and to protect customer assets from creditors. This will help to protect investors from losses in the event of a stablecoin issuer becoming insolvent. Overall, Singapore's new stablecoin rules are likely to be a positive development for investors in the country. The rules will increase transparency and accountability, reduce the risk of fraud and abuse, and improve investor protection. This will make it easier for investors to assess the risks and merits of different stablecoins and to make informed investment decisions. As an investor, you should carefully consider the new stablecoin rules before investing in any stablecoin. The rules may make some stablecoins more attractive than others, depending on your individual investment goals and risk tolerance. You should also make sure that you understand the risks associated with stablecoins before investing. That's all for today, folks. I hope you enjoyed this video and learned something new. If you did, please give it a thumbs up, share it with your friends, and subscribe to our channel for more awesome content. And don't forget to leave a comment below and let us know what you think about stablecoins and crypto regulation. Thank you for watching, and until next time, this is Larry, your co-host from the Investing Iguana, signing off. Stay safe, stay smart, and stay crypto.